The average investor is not destroyed by one bad stock pick. They are destroyed by weak cash flow, poor liquidity, and the need to sell at the worst possible time. If you want wealth that compounds, you need habits that look boring from the outside and extremely efficient from the inside. Here's the framework. Frugal people are not trying to look cheap. They're trying to increase surplus capital, protect optionality, and reduce financial volatility. That is the same logic you use in portfolio management. You control inflows, limit unnecessary outflows, preserve liquidity, and make sure time stays on your side. When frugal people say they live by boring habits, what they really mean is they've built a personal balance sheet that can survive stress. The market runs on cash flow, liquidity, rates, sentiment, and positioning. Your household runs the same way. If your cash flow is unstable, every decision gets worse. If your liquidity is low, every surprise becomes expensive. If your spending is tied to emotion, you become reactive, and reactive people pay the highest prices. So the first habit is that they track where money goes, constantly. Not because spreadsheets are exciting, but because unmanaged cash flow behaves like unmanaged risk. You do not improve what you do not measure. Most people misunderstand this because they think budgeting is restrictive. It is not restrictive, it is diagnostic. When you can see the leak, you can fix it. When you cannot see it, you create stories instead of decisions. The second habit is they keep a cash buffer before they reach for returns. That sounds slow, but it changes everything. In markets, liquidity gives you patience. In life, cash reserves give you bargaining power. If an expense hits, you don't liquidate investments, you don't borrow at bad rates, and you don't make desperate choices. Most people get this backward. They chase higher returns while carrying fragile cash positions. That is like buying volatile assets with no risk controls and calling it a strategy. The third habit is they repeat meals, repeat stores, and repeat routines. It looks dull because it is. That is the point. Decision fatigue is a hidden expense. Every unnecessary choice is a chance to spend emotionally. Frugal people standardize low-value categories so they can stay flexible in high-value ones. In investing terms, they remove noise so signal becomes visible. The fourth habit is they delay purchases. Not forever, just long enough for urgency to die. Momentum drives markets, and momentum drives spending too. The first impulse is rarely the best price and almost never the clearest judgment. So you create a pause. If you want the item after 3 days, 7 days, or a full billing cycle, then you reassess. Most people think the win is finding a discount. The actual win is discovering you did not need the item at all. The fifth habit is they buy boring quality where replacement risk is high and go cheap where performance doesn't matter. That is capital allocation. You spend hard where failure is expensive and conserve capital where the upside is cosmetic. Shoes you wear daily, tools you rely on, insurance you actually understand, those deserve analysis. Decorative trends, convenience upgrades, status purchases, those deserve skepticism. The sixth habit is they automate savings before discretionary spending begins. You do not leave investment contributions to mood. You remove them from the decision path. If income comes in, capital gets assigned immediately. That single move defeats overconfidence, lifestyle creep, and the fantasy that you will invest whatever is left over. Usually, nothing is left over. The seventh habit is they treat recurring expenses like long-duration liabilities. A one-time purchase is rarely what damages a plan. Subscriptions, financing, delivery habits, premium upgrades, these are the real drag. Small monthly outflows compound against you exactly the way small monthly investments compound for you. Most people underestimate this because they focus on price, not duration. This is where most people stop, but this is the advanced level. The advanced level is understanding second-order effects. A frugal habit is not valuable only because it saves $10 today. It matters because it changes future behavior, future flexibility, and future risk exposure. If your fixed costs are low, then a job loss is not a crisis at week 2. If your liquidity is high, then a market sell-off becomes an opportunity instead of a threat. If correlation breaks down across your life at the same time, income pressure, rising rates, falling assets, Higher stress. The person with boring habits survives the mode change. The person chasing appearances gets trapped in a liquidity spiral. That is why the eighth habit matters. They keep fixed expenses low on purpose. Rent, car payments, debt obligations, recurring lifestyle commitments, those are personal leverage. Leverage feels efficient until volatility arrives. Then it becomes a liquidation engine. Bankruptcy risk mathematics is simple at the household level. Once fixed obligations rise above your ability to absorb shocks, one adverse event becomes a sequence. Frugal people know the sequence is the danger, not the event itself. The ninth habit is they compare unit economics, not branding. Cost per use, cost per mile, cost per year, cost per ounce. You do the same thing in valuation. You normalize the surface number so the real economics appear. People misunderstand prices because they buy stories wrapped around prices. Frugal people strip the story out. The 10th habit is they say no to lifestyle inflation after income increases. When cash flow rises, most people let spending rise first and investing maybe rise later. Frugal people reverse that. If income moves up, savings rate moves first. Then lifestyle changes only if the change does not reduce resilience. If the market moves against you, you react by protecting capital. If your income moves up, you react by expanding ownership, not consumption. The 11th habit is they plan purchases around timing. Not because timing is everything, but because timing matters when liquidity is limited. They buy off-season, negotiate when demand is low, and avoid buying under emotional pressure. The same decision logic applies in markets. Forced entries are usually bad entries. Forced spending is usually bad spending. The 12th habit is they review statements. Every month, every category. No drama, just review. This is your information signal. You look for drift, hidden fees, rate changes, impulse clusters, and small errors that become habits if ignored. Most failures in money management are not explosive. They are gradual and uninspected. The 13th habit is they define enough. That is the quiet one, and it may be the most powerful. Without a definition of enough, every increase in income becomes fuel for comparison. With a definition of enough, surplus becomes investable by default. That is how boring habits turn into ownership. Now apply it like an operator, not a spectator. Start with your cash flow. If income is stable, direct a fixed percentage into reserves and investments before discretionary spending begins. If income is unstable, build a larger liquidity buffer and reduce fixed costs first. If expenses spike, cut variable categories immediately instead of pretending the spike is temporary. If markets fall and your emergency cash is intact, keep your investment schedule running. If markets rise and you feel richer, do not let spending front-run your balance sheet. Position size matters in life exactly as it does in investing. Big commitments should only be taken when the downside is survivable. To build this skill, journal purchases the same way a disciplined trader journals entries. What triggered the decision? What alternatives existed? What signal you relied on? And what the long-term cost will be. Reverse test it. Look at the last 3 months and ask which expenses improved your life and which merely relieved impulse. Simulate stress. Cut income by 20% on paper and see what breaks first. Then repair that point before reality tests it for you. Maintain the skill with simple rules. Track savings rate, fixed cost ratio, months of liquidity, and the percentage of raises that go to investments. Combine this with valuation, macro awareness, technical timing, and risk management. The point is not to become extreme. The point is to become anti-fragile. When pressure rises, your process should become clearer, not weaker. And if you reread this carefully, you'll notice the entire system turns on one quiet variable that most people ignore until it disappears: liquidity.